Today we're focusing on the FOMC last night because stocks and risk went absolutely crazy after Jerome Powell ended up turning pretty dovish with his monetary policy. We're going to take a deeper look there at what happened. And the trading takeout today is going to be how to understand regime change. It's one of the most important concepts in markets to be able to catch those trends. So we're going to have a look at what you can do to benefit from it. Before we get into today's video though, make sure you hit subscribe and like this video so I pop up in your YouTube feed every day so that you can maintain your trading edge. So, of course, if we were paying attention yesterday, and I actually didn't mention the FOMC yesterday because I tend to just not necessarily ignore it, but I don't like to predict what's going to happen at the FOMC. And, you know, I think it's best to stay out of recent FOMCs. But what happened? Well, Powell was relatively dovish. And I'm going to run through, after I've looked at this chart, some of the comments that he made and how the market has reacted. Interest rate market, that is, not necessarily just equities. But you can see pretty much what it's signifying, right? It shows dovishness here. Market came straight off of the 46.50 level and just went straight up. It was quite remarkable. You know, 55 or so handles, maybe a little bit more, maybe 60 handles there, and it's testing the high again, or will do later today at the open. Now, if we actually look at the interest rate pricing, let's take a look. You can see the extent of the shift. So Powell specifically had said that cuts had now come into view. And what's actually being priced is, I believe, 3 or 4 cuts from looking at this for next year. If you haven't seen this before, I do go through this maybe every other week, but if you haven't seen this before, what you're looking at here is 100 minus this number is effectively the target range. So right now we're at what? 5.25%. Okay, so 5.25% to 5.5%. And so where we are looking is the cuts to start coming into play here, okay, which is the middle of next year, so July-ish next year. And then gradually, it becomes, becomes more and more dovish as we move through 2024. So by the end of next year, we're looking at 4 cuts. Okay, that's what the interest rate market is pricing now. And you can see from this line here, from these other lines, not the blue or the orange ones, you can see from those that the term structure is what this is called, or the term history has shifted. So this is quite hawkish down here, not hugely as we head into the back end, but the shift from here up to here is massively dovish. It's good for risk assets. It means that assets relative to interest rates have become cheaper. Obviously, higher interest rates mean that the opportunity cost of holding higher risk assets is greater. Because, for example, you can go and invest in bonds and get 4.5%, 5%, instead of investing in equities, which, you might get less of. But the equity market is not really showing that, even with higher interest rates. So it's a very, very interesting conundrum. We're nearly at all-time highs again, even though interest rates are at 5% and a bit. So what could the function of that be? Well, let's have a look. If we type in Fed balance sheet, but effectively, the Federal Reserve balance sheet is possibly the thing that is reminding the market that there is still a lot of liquidity left. And the only real alternative for central banks now is to revert back to cutting, is to revert back to providing liquidity at some point. They're too far through. And so what the market's consistently betting on is, what is the point in betting on down if indices are designed to go up? And also, we know that the Fed is going to come back with looser monetary policy at some point. The market just doesn't see it as being something necessary to price the market down. You know, it just doesn't deem it so, especially when growth is at 5.2%. Unemployment hasn't shifted either. And so, and that's actually something that Powell said. And let's actually get onto Powell's comments. So here's all the things that he had said with regards to unemployment. Where did he mention unemployment? Here we go. So he said right at the start, actually, inflation is eased without a significant rise in unemployment. Remember that full employment is one of the Fed's goals. Okay. Inflation is still too high, fully committed to returning inflation to 2%. But it's on the right trajectory. I can't even say that word sometimes. So it's on the way down. Okay. Policy is well into restrictive territory. Full effects of tightening are likely not yet felt. Fed is proceeding carefully given how far they have come. Well, that's fine, but then you're mentioning cuts as well later on. So you're looking to unrestrict that territory. So, for example, he says here, discussion on when to cut rates is still ahead. We'll decide very carefully. And this is where the turning point in the statement sort of comes. Previously, there was no talk of cuts. Now there's talk of cuts. That is, and we're going to go on to that in the Trading Takeout, but that is a regime change. You know, we're at the start of a regime change here. He says that the difference in projections reflects lower inflation than previously expected. Fed is conscious of real rates. It is part of how the Fed talk about things. Now, if we want to look at something to do with real rates, then we should probably speak about gold at the same time. Now, even though gold is affected by real rates, what we're actually looking at here is gold having rallied. Now, if he's thinking that real rates are likely to fall, then that is beneficial for gold. Okay, so there's a signal there as well from a direct speech of a central banker. And so, you know, if this is something that is a component of how you think about the market, it pays to pay attention to, you know, what the Fed chairman or whichever central bank governor says when it comes down to real rates, when it comes down to fixed income, et cetera, et cetera. And then if we want to go a little bit further, Fed has not worked out if they follow a threshold-based path for cutting rates. That's not necessarily that important in our context. Maybe if we talk about the balance sheet is working pretty much as expected. At a certain point, the reverse repo facility will level out and reserves will come down. They're watching reserve level carefully. So something that I'm also watching now that he's mentioned this is something called a basis trade, which lots of hedge funds have got into. And it's effectively where they are long US treasuries, they're borrowing from the repo facility while also shorting the treasury future. And then they make up a small spread off of that. Now, one of the key things with this trade is that if rates do come down drastically, there's going to be a rush for the exit. Now, the big boys like Citadel, Millennium, et cetera, they're all in this trade. And regulators have recently pointed out the dangers to financial stability of this trade. So it's very, very careful to think of also the tail risk side of rates coming down. It's not all, you know, fairies and lovely spring gardens. It's okay, why are rates coming down? Is Powell foreseeing something bad within the market? And that is always something to pay attention to. But I think let's get onto the Trading Takeout now. Let's focus on regime change and how you can benefit from a broader trend change. Now, there's various ways in which you can deduce whether a trend is changing, or more specifically, whether a regime is changing. But me coming from a macro perspective, I really love to focus on interest rates and what the central bankers are saying. At the end of the day, they control the money supply, they control the opportunity cost between assets and asset selection. So for me, it makes most sense to focus on what people like Jerome Powell, Bailey at the Bank of England and Lagarde are saying about interest rate policy. For example, Powell's speech yesterday, there's been a big pivot now in terms of, okay, well, we weren't talking about rate cuts previously, but now we're going to start to. That is a massive, massive change in specific trends. And we can see that through how, US treasuries have started to behave. Yields have softened massively in response to looking forward at potential rate cuts coming into play. Make sure that you pick just one thing, one or two things that you can use to deduce when a regime change is happening and stick with it. This could even be just a longer term moving average or some form of pattern, but something that you notice that occurs more often than not that is successful at creating a new and broader trend.